So let's talk a little bit about investments. If you're new to investing, you're eventually going to hear the advice, diversify. This is the advice that almost all financial advisors and texts on the subject give to people who are new to investing. And if you've been involved with investments for some time, you've heard the advice to diversify over and over and over again. So what does it mean to diversify your portfolio, and why does the way it's practiced by most financial advisors have an outcome that's not very good? So let's talk about that. The whole idea behind diversification in investments was originally applied to equities. So, and why would you apply it to equities? You want to manage the risk, right? So if you think about it, if you invest in a single company and that company goes bankrupt, you lose all your money. So the concept here is not to invest in just one company or even one sector, but to invest in multiple companies. So let's say you like railroads. You might want to invest in several railroad companies. You want to invest in biotech, so you invest in a couple of those. You want to invest in social media, you invest in a couple of those. So you build up a portfolio in different sectors with multiple companies in each sector. So that diversifies you against any one company going out of business or any one industry having a temporary setback or even going away. So that's the whole concept originally behind diversity. And I think what's happened is financial advisors have decided to take that a little bit further. Not just financial advisors, financial planners, and other financial experts, people who study CFAs and also CPAs, accountants. So what have they done? They've said, well, if diversification is good for equities, let's take that a step further and apply it to the entire portfolio. So we'll not only put you in a diverse array of equities, but we'll put you in equities of different sizes. We'll put you in equities from foreign countries, emerging markets. We'll put you, so that diversifies your equity portfolio in small cap and large cap. But then we'll also put you in diversified bonds. So we'll put you in corporate bonds, government treasuries, foreign, both corporate and government treasuries of foreign entities, and we'll put you in high yield bonds. So we'll diversify you into bonds. And by the way, while we're at it, let's throw in some real estate and let's throw in a basket of commodities. So now you've got everything in there, pretty much including the kitchen sink, and that should protect you. The sad part is it actually doesn't work, and I'll show you that in a bit. It's not that financial advisors are bad, or evil or trying to do anything to hurt you. They're actually trying to protect you. But given the tools they have to work with, they don't understand the real ramifications of that. And I'm going to show that to you here. So before I get started on that, let's talk a little bit about visualize my portfolio and how that will play into this. Now, don't be afraid because this is a graph. It's very, very simple. If you look at this and forget about the axes for a minute, it's a very simple concept. In fact, it's even color coded for you. If your portfolio or investments in your portfolio are up here in the upper left in this sort of blue area, that's very good. If your investments or portfolio are down here in the, toward the reddish or purple or, orange, red, fiery area down here, that's very bad. So very simply, upper left is good, lower right is bad. And you'll be able to see this very quickly as I show you some of these diversified portfolios. For a little more detail, the left-hand axis is compound annual growth rate, which basically gives you your return. And that's the return you'll get on average annually over a long term. In this case, long term is 10 years. So this one goes from 0% to 30% here, and from 0% to minus 30% here. We measure risk on the horizontal axis, the bottom axis, by using what we call maximum loss or drawdown. This is the pain if you were invested in 2008, this is the pain you felt. How much money did I lose? What percentage of my portfolio did I lose when the market dropped from its peak in 2007, October of 2007, to the bottom in March of 2009? So this axis goes from 0% loss over here on the left to minus 100%. You lose all your money over on the right. So now that we have that out of the way, let's talk about why over-diversification doesn't serve you well. What you're looking at here is you see a bunch of spheres on the graph, and I'm going to start with the big white one. The big white one is your total portfolio. That's everything. That white sphere is comprised of all the other spheres on this graph. So if you look at it, we have the corporate bond index, AGG, here. Over on the left, we've got high yield bonds here. We've got the S&P 500, which kind of represents large cap stocks. We've got mid cap, small cap, foreign, large cap, emerging markets. We've got real estate, and we've got commodities. So again, everything including the kitchen sink here. And this is a fairly conservative allocation. It's 60% in fixed income and 40% in equities, real estate, and commodities. And by the way, the size of each of these bubbles, these smaller bubbles, represents the proportion of that investment in the portfolio. So you can see AGG, the bond index, is 56% of the portfolio. So it's a fairly large sphere, while commodities are a much smaller percentage of the portfolio. And so therefore, the sphere is smaller as well. So what happens now, and by the way, this is a fairly conservative portfolio. If you really, really wanted to be conservative, you would put almost all your money in the bond index, maybe keep some in cash, and your return would be somewhere over here for a very conservative portfolio. But we're just going to deal with this fairly conservative portfolio, and then we're going to show you a moderate portfolio followed by an aggressive portfolio. So let's see what happens here. I'm going to change this from a conservative portfolio to a moderate portfolio and see what happens here. Let's take a look. Here is a moderate portfolio. You can see the corporate bond, or the bond index sphere shrunk. These equity indices these equity portions got a little bit bigger, and so on. And the sphere moved from over here to over here. So, there's something really wrong here if you think about it. If you think about, let's talk about risk first, risk versus reward. If you take a very low risk, you should expect a fairly low return. Makes sense, right? I mean, everybody kind of intuitively knows that. If I'm going to take a very conservative approach, then I should expect less out of it. And that applies to life as well. So if you think about it, taking very little risk should garner very little return. If you keep all your money in a checking account, or maybe a money market, recently you were getting 0.01%. Back in the old days, maybe you got 0.5% or 1%. And as you take more risk, you should expect more return for the risk you're taking. So that relationship looks something like this. So let's go back to the conservative portfolio. So you can see where the white sphere is. It's a little over 5%. And then we go to a conservative portfolio, and it really doesn't increase the return. It only increases the risk. This has over almost a 40% maximum loss, while the conservative portfolio had, I think, a 27% maximum loss. So all you're getting is more heartache, more loss, and no more return for taking more risk. So let's go back to the moderate portfolio. And then let's now put in an aggressive portfolio and see what happens. Maybe that's what's wrong here. Wow. So again, the total portfolio, the white sphere, moved totally sideways. In fact, it actually moved a little bit down, if you notice. Let's go back to the moderate, aggressive, moderate, aggressive. And if you notice it moves slightly down. So you're actually getting a little bit less return, but now your risk is well north of 45%. You lost back in 2008 45 or more, almost, I think, I don't remember the exact numbers here, but 45, 48%, whatever. It was a lot of loss. And that's not a good thing. So this is why over diversification isn't good for you as an investor. And when we talk on my next vlog, I'll show you how we can use Visualize My Portfolio to determine better ways to invest without over diversification and get a better relationship between return and risk, the one that you would expect. Thank you for watching today.